In this video, we are going to talk about Uber results, why the stock fell almost 7 or 8% after the result, and today is back plus 4% up because they had kind of good results. So why did the shareholders, the investor, got scared about Google? And then we'll do an valuation, okay, with my DCF model to check at what price it can be interesting to buy Google and if there is some good potential value in this stock. So when it comes to growth, okay, we will go kind of fast here because there is not a lot to say. Very good growth, okay, 18% gross booking, 20% revenue growth year over year, adjusted EBITDA plus 44%, income from operation plus 18%. So we have two-digit growth for the company, which is very, very good. We have a net income of 6.9 billion, okay, but here you need to understand that they have 6.4 billion in tax valuation release and 556 million from unrealized gains on equity investment. They invest a lot in other companies like Grab. I don't know all of them, but they own the parts, some equity in Grab. So here's where it comes from. If you take out the tax valuation release and the unrealized gain on investment, on equity, you have almost or a little a negative net income. And this, you need to understand that is not something coming directly from the operation. You have a loss also, this is for the quarter, okay, by the way, it's not for the full year, this is a net income for the quarter. They had a loss in freight business, okay, minus $22 million compared to minus $14 million in the Q4 2023. The mobility growth is up 18% year over year. Delivery growth booking up 18% year over year, and trips plus 18% year over year as well. You have 33 million trips per day on average booked, so it's very good. Uber One plus 60% year over year, okay, it's now 30 million member, so it's very, very solid. Expected for 2025, the Q1, you have a gross booking which is expected to be between 17% and 21% growth. So it's a bit less than what we've seen here, but it's still a good range. So will we be more at 17 or 21? I think that will make a difference in the next earning call, because if we are more around 17, maybe investor will be disappointed with the result. If we're around 21%, maybe there will be a good surprise on the market. So we will see. And adjusted EBITDA expected to grow between 30 and 37% year over year, like for the next year, which is here a growth of 44%. So we'll have less growth, still a good growth. Okay, 30% is very good, but a bit less than before. For margin, we have a EBITDA margin of 4.2%. Mobility margin was 7.8%, which is down from Q3. In Q3, what, 8%. And you have a very low delivery margin, which is 3.6%. It's improving, but it's not really good. And here's the problem of Uber, it's the margins. The margin are so low that I'm not saying it will not go higher and so on, but we expect a lot of improvement here. And going from an EBITDA margin of 4% to 12, 15%, it can take some time. I don't know if they will manage to do it in the next 5 years, but we will see. I think here is where the value will be unlocked. If they manage to really have higher margins, it will be great, because if you want to have a quality company in your portfolio, generally, you're looking for margins that are higher than 15%, especially for EBITDA margin or operating margins. So here, there is some lag for Uber. When it comes to capital allocation, the main thing to know here is they plan to do a buyback of 1.5 billion, like it's what they announced, and the plan should be 7 billion. So it's 7 billion for the year. So 1.5 still kind of in a range, because if you multiply it by 4, you will have what, 6 billion. So it's almost 7 billion. So maybe they will do an extra billion if the stock go really down and so on. But to be fair, 1.5 billion seems little, especially if we consider the stock undervalued. Like if we consider the stock that much undervalued, why they didn't use like half of this 7 billion to do buybacks already, or why they don't do more than 1.5, why they don't do 2.5. So it's some question to ask, because If they do 1.5 and keep the 5.5 billion left for the continuation of the year, is maybe because they expect that the stock will decline a bit more during the year to do more buybacks at this moment. And the stock is not low enough now. So it's a bit strange that they did only 1.5 billion and not more. So yeah, the big question here is why are they not more aggressive on it, especially considering that now potentially the stock is at a good price. So what went wrong? Generally, I think the decline is mostly due because they have low margin and profitability is still low. And maybe some investors start to be worried about the improvement of margin for the future, because you can see that mobility margin everything didn't really improve a lot and is still very low, especially when you see mobility margin decreasing a little from quarter to quarter. Also, maybe not enough aggressiveness in the buybacks from the direction, and probably not big enough growth perspective for 2025. When here it's 30 to 37%, it's less than what we have now. 17 to 21%, it's less than what we have now. So maybe people got disappointed with this. When it's come to value, we'll do the value with two different earnings. This earning is from operating incomes, which have been made with each quarter plus the first quarter of 2025, the expectation for first quarter 2025. So last 3 quarters plus the next quarter, what will be expected. And this one is the earnings for 2025, the earnings that they plan to have, the net income that they plan to have in 2025. I use both. I will use those two because in the earnings, they have some equity and so on. So that's why I didn't really want to do it. I wanted to have one with just the operational, just the activity of the company, and another one with more the income that they will make. So if they do 1% buybacks, the stock is $67. We expect for the future to have a P ratio of 20. Okay, in 5 years we say, okay, the P will be 20. If you want to do 13% per year, you will need to grow to buy the stock before it arrives $76, $77, and to have a growth rate around 30%. To be fair, like you need 27. You need 27 growth if you want to do 13%. If you want to do 10% per year, you need 23. 23 and a half. If you want to do 10% per year, you need 23 and a half growth for the earnings. So if you think the company can grow 23%, have a PE of 20 in 5 years, you can make 10% per year. Personally, I don't want something that doesn't make at least 13% per year. And Uber is not in my portfolio, it's not in my watch list because for me the company is still too young. The company doesn't have high enough margin. I'm not interested in a company with under 15% operating margins. So for now, Uber doesn't interest me. Maybe in 5 years, 10 years, when the margin will be higher, I will have some interest, and maybe probably at this moment, the stock will be way higher than $67, but I don't want to take this risk for now. Now, if we go with 5,000 earning, so 5 billion earnings, okay, that's 5,000, we just need, and we want a PE of 20, we will need a growth of 16% per year to have 10% per year, and 20% growth in earning per year for the next 5 years if you want to do 13%, which is doable. Okay, it's very doable, but they don't have a lot of margin of safety in a sense that if they miss something in 1 year, if they fucked up something, or if they do big investment and they don't have net income, if they don't have this growth, you can have a problem. I think asking for 20% growth for a company like Uber for the next 5 years is doable, but doesn't leave you a lot of space, a lot of margin of safety. So that's the reason for why I'm not invested in Uber, why I don't plan to invest in Uber in the next weeks, in the next months, probably in the next years, because till we don't have better profitability, higher operating margin, Uber is not a company that I consider to invest. When we'll have higher than 15% operating margin, maybe I will consider investing in this stock.